Hi. Okay. So, um, you must know the difference between management accounting and financial accounting. Financial accounting is what you must do according to the law. You know, the law says that you must do. Whereas management accounting is what management accounting is optional. Is what the company boss, some accounts work that the company boss want to do, so as to help him in his decision making and help him in his business. Okay, so now I'm giving you example. For example, you see, you intend to start a manufacturing business. You intend to rent a factory to manufacture army uniform because you see the potential in it. Okay. In Singapore, all the boys have to go to army, so you see the potential in manufacturing army uniform. So you go around Singapore and look for a factory, and you find one reasonable one, not very big but suitable, $1,000 a month. So your estimated fixed cost, that means the cost that you have to incur even though there's no business. This estimated annual fixed cost. So you found a factory, $1,000 a month, so a year will be 12,000. Okay, and then even though you have no business, for example, if there's no business, you still have to probably employ a staff to maybe something like security guard or caretaker to take care of your factory, and then the salary is $500 a month. Okay, so a year will be 6,000, and then some other miscellaneous cost is 2,000. Okay, this 20,000, 12,000 plus 6,000 plus 2,000, this 20,000 is your fixed cost. That means the cost that you will have to incur even if there's no business at all. Okay, so this is your estimated annual fixed cost. So you estimated that your yearly cost will be 20,000 even if there's no business at all. So so that means this is the worst case scenario. If there's no business, you have to come up with 20,000 for all these fixed costs for 1 year, um, yearly. And then you estimate that your factory can produce and sell 20,000 sets of army uniform a year. So this is what you estimate. Okay. So so now you have do your background work, do some research, and you have come up with these estimated figures. And then now the government, for example, MINDEF, will be putting up a tender for supplier to send in their tender and offer how much they are going to sell their army uniform to the government. Okay, so so there will be many other suppliers, many other factories who will also send in their tender, who will also bid for um, the the supplies of uniform to MINDEF. Okay, so you have to be very competitive. You have to offer the lowest possible price. Otherwise, you won't secure the contract to supply the army uniform. Okay, so now I have come up with some estimates. Okay, so for one army uniform, I estimate that my raw material, mainly my cloth, button, zip, for the army uniform is $10 uh, for per set of army uniform. Okay, direct labor. Okay, so all this direct labor is I can manage it in such a way that it's my variable cost, because if there is no, for example, you see this 20,000 is my fixed cost. Okay, you see this kind of direct labor is, I can manage it in such a way that it can be my variable cost. Raw material, so it is actually a variable cost, because for example, if there's no business or there's less business, I will buy less cloth. Okay, or if there's no business, then I don't buy. I will only order when there is business. Direct labor, same thing. I will only get the hourly rated staff, or the production staff when there is business. Okay, if there's no business, we don't hire them. So this is variable cost. So the direct labor I estimate is $7 per hour, and it take 2 hours for the staff to make one army uniform, for example. Okay, so $24 will be my total direct cost, which is my variable cost. Okay, then how about all these 20,000 fixed costs? How about all these 20,000 fixed costs? Because now I'm going to estimate what is the total cost for one army uniform. I have to factor in my fixed cost. Okay, otherwise I won't get the exact cost per unit of army uniform. Okay, so so you see, I estimated the yearly fixed cost to be 20,000, and I estimated that 1 year can manufacture 20,000 sets of army uniform. So my fixed cost per unit of army uniform will be $20,000 divided by 20,000 set will be $1 each. So my total cost per unit per unit of army uniform will be $25. So that means I know the bidding environment is very competitive. So I have to make sure that I have to sell my army uniform for at least $25. I can sell for $25.10, but I cannot sell for $24.95. Because if I sell for $24.95 or 24.99, I'm going to make a loss. Is it you got to multiply by a huge number. So even if you make a 1 cent loss, it can be a huge loss if you produce a lot. So you cannot sell below cost, and you must realize that you must calculate your cost per unit accurately, because the bidding environment, there will be lots of supplier going for the bid, tendering for the contract, and it's going to be very competitive. So I have accurately calculate my cost per unit, and I will make sure that no matter what, I have to sell or offer to sell the army uniform above $25. It can be 25.01 cents, yeah, but it cannot be less. Okay. Okay, you see here now, this example that I'm showing you assumes that my factory only produce one type of product, and all the products are the same. All the army uniform are the same. Okay, but in reality, if factory like this, garment factory, garment factory like this, um, garment factory will produce many types of clothing made from shorts, or it can even produce a very sophisticated wedding gown or evening gown. So if you allocate this fixed cost, this indirect fixed cost, these overheads, this fixed overheads equally to all the units product equally. That means here I'm assuming that one unit of product are $1. Then it's not fair, because a shorts may take only half an hour to produce, for example. A wedding gown may take 20 or 30 man hours to produce. So how can you allocate the indirect fixed overhead equally for each product? So what I'm going to do is okay, you see this one, this is called overhead absorption rate. Overhead absorption rate means your budgeted overheads is 20,000 over the budgeted production units is overhead absorption rate. So in this case, it's budgeted overheads over budgeted production units. Okay, so this formula is true for a simple environment like this, where all the products are same. But for a more complicated environment, where the factory produce shorts, wedding gowns, t-shirts, and all kinds of things, then the overhead absorption rate will be my budgeted overheads. My budgeted overheads divide by the budgeted machine hours. You can divide by the budgeted direct labor hours. Depends whether your factory is machine intensive or labor intensive. Okay, for example, because nowadays most of the factory are machine intensive. So I assume that we use machine hours. So we take the budgeted overheads divided by the budgeted machine hours. So for example, if the total budgeted machine hours, um, we foresee that for the year ahead, the the total budgeted machine hours for that year ahead, it will be 20,000 hours. Okay. so so the overhead absorption rate in this case will be 20,000 divided by 20,000 hours, $20,000 divided by, so it's $1 per machine hour. This is the overhead absorption rate. Okay. So for example, if it takes 2 machine hours to make one army uniform. So okay, just now I explained the total direct cost is 24 hours. So the overhead, the fixed overhead allocation for one army uniform will be, this one is the overhead absorption rate, will be $1 per machine hours times 2 hours. So this is an example how you allocate the indirect overhead based on machine hours. Okay, so the budgeted cost per unit of army uniform is $26. So you see all this overhead absorption rate and this budgeted cost is what we are going to do at the very beginning of the year, before the start of the year. Okay, this is our planning stage. We have to we have to do this so that we know what is the budgeted cost for this coming year ahead, and then we will make sure that we price our product above our budgeted cost per unit. It makes sense, right? Okay. So okay, for example, if now this is a wedding gown. So the wedding gown may take 20 machine hours to manufacture. So the allocation of indirect fixed overhead for wedding gown will be $1 times 20 machine hours will be $20. Then 24 plus 20, then the budgeted total cost per unit of wedding gown will be 24 plus 20 will be 44, for example. Okay, so now you have understand the planning part. That means all this planning will happen at the very beginning of the year, before the start of the year. Okay, this is the planning part, or before you even start the business if it's a first year. Okay, so now we look here. Okay, so that means step one, step one is what we are going to do before the start of the year, at the very beginning. Okay, is the budget the yearly overheads and calculate OAR. OAR means our overhead absorption rates, and then we will find out the budgeted total cost. So this is what we are going to do at the very beginning, before the start of the year. Okay, you see, I have explained earlier that I have explained just now that financial accounting are the accounts that we have to produce to satisfy the government. It's what we have to produce according to the law, okay, to satisfy the government. Management accounting is what we do to improve on our business. That means the boss wants this management accounts to be produced so as to help him in his decision making. It's not optional. I mean, it's not compulsory that you do. But bosses, factory bosses normally, or manufacturing company bosses normally want it to be done so as to help him to manage his business better. Okay, so normally, for example, you yourself, if you open a factory, that means you are doing quite a decent sized business. I would say quite a big business. You have a factory, and then you hire staff, and you are doing manufacturing. You are doing quite a big business, Okay, and you have invested, quite a lot of money. You see, your yearly fixed cost is 20,000, and then 20,000 is quite a lot of money, So you are very concerned about your business. You would want to monitor the performance and the profit of your business very regularly, because you are very concerned about your business. What if my money is gone? What if I lose money? So you as the boss of this manufacturing company, this factory company, is very concerned. And then you want your staff, your account staff, to produce your profit and loss account either real time, if your accounting software allows it easily to produce real time, or you want it, if not, at least you want your profit and loss account very regularly. For example, at least monthly. Some bosses may want it weekly. It depends on you as the boss. Okay. So you see, earlier on, we have learned that when we do the profit and loss account, we have to do balance day adjustment. That means our accrual and prepaid. Okay, we have to apportion the how much prepayments, and then we have to accrue for whatever expenses that's not paid. It's very troublesome. Okay, this accrual and prepayments are mainly our so-called fixed overheads. You know, fixed overheads like rental, staff salaries, and then utilities and insurance, and all these are mainly our fixed overhead, depreciation, all this. It's very troublesome to calculate all this on such a regular basis, you know. If we do it once a year, it's okay. Yeah. At the year end, we get everybody to work OT and produce the uh very nice actual figures of the fixed overhead for us. But you want us to do every month, is going to be very troublesome. Uh, we don't want to spend such all the headache and all the staff, and hiring more staff or paying more overtime to the staff to do all this kind of work for us, right? Okay, but all this raw material, direct material, I think is quite easy to count, because raw material, when we will order when when there's job, and it's not very difficult to estimate. So that means the direct cost is not very difficult to estimate. But the fixed overheads, if we want to get the actual figure every month, we have to do the balance day adjustment, do all the accrual and prepayment, is actually quite difficult. So what we are going to do, you see, at the beginning of the year, we have already find out our overhead absorption rate. Okay, so in order to find out the total overheads, okay, so in the profit and loss account, we have to so-called gather all our expenses, all our cost of sales and all our expenses. Okay, the direct costs are actually our cost of sales, you know, the direct costs. Okay, the overheads part are mainly the expenses, including depreciation and salary and everything. Okay, the overhead part, we have already estimated at the very beginning of the year our overhead absorption rate. This is already what we have calculated at the beginning of the year. And as the months goes by, we will rely on this overhead absorption rate to estimate our monthly fixed overhead, to estimate our monthly fixed overhead. Okay, so this monthly fixed overhead that we are estimating based on our overhead absorption rate, we call this total overhead absorb for that month. Okay, for say, for example, total overhead absorb for January will be equals to our overhead absorption rate times our actual machine hours. Okay, this is based on the assumption that our overhead absorption rate is derived based on the budgeted machine hours. Okay, which is usually the case. We derive the overhead absorption rate based on budgeted machine hours for most of the case. Okay, some of the case we use direct labor hours, okay, or per unit basis, but most of the time is budgeted machine hours. Okay, so that means the total overhead absorbed for the month, for example, for January, will be equal to the overhead absorption rate times the actual machine hours. You see, as the production progresses, we will clock in our actual machine hours. Okay, actual machine hours is not very difficult to find, because normally when the factory staff goes to work, he will have a clock card. That means they will clock the time. They will clock the time where he works or they will record their working hours daily. Okay, so it's not very difficult to find actual machine hours. So the overhead absorption rate is what we have calculated at the very beginning of the year. So our total overhead absorbed for the month, for example, for January, will be the overhead absorption rate times the actual machine hours for that month. Okay, so now we will use this total overhead absorbed in our monthly management account. Okay, for our overhead expense as our overhead expense figure, so that we can estimate our profit as accurately as possible every month, without incurring too much hassle in doing all the accrual and prepayment every month. Okay, at the end of the year, step 3 is, so step 1 is what we will do at the before the start of the year. Step 2 is what we will do on a regular basis every month. All right. Okay, so we will calculate our total overhead absorbed every month as production progresses every month. Okay, step 3, at the end of the year, okay, we have to do our management account for our boss, for you, if you are our boss, and also we have to do the financial accounts for tax purpose. Yeah. So when doing the financial accounts for tax purpose or submitting to the government, we have to use the actual figure. Okay, no choice. So at the end of the month, we will get our staff to work overtime to do all the accrual, prepayment, depreciation calculation, and all these kind of things, to get the actual overheads, to calculate the actual overheads. Okay. So you see, budgeted overheads is what we do at the beginning of the year, or what we say at the start of the year. So it is the budgeted means estimated overheads, estimated figures to derive our overhead absorption rate. Then as production progress, we will calculate the absorbed overheads every month. It will be the overhead absorption rate times actual machine hours or labor hours, but most of the time we use machine hours. Okay. Then at the end of the year, we will calculate our actual overheads. Okay. So we will calculate our actual overheads, but in a management account, you see, there's two set of account. In the management account, we will still put the total absorbed overhead for the whole year. Okay. But we will put an adjustment, a line for adjustment. The adjustment, that line will be called under or over absorption of overheads. Okay. That is because we will compare our actual overheads with our overhead absorbed. Then the difference would be an under or over absorption. So remember, in our management account, we will use the absorbed overheads for the year. Then after that, below the absorbed overhead, we will have one line, under or over absorption, so that this is so-called to adjust the total absorbed overhead for the year into the actual overheads. So that means the total overhead absorbed plus or minus under or overhead absorption, over or under absorption of overheads, will be equal to your actual overheads. Right? So that means we are adjusting the total overhead absorbed with this under and overhead absorption, so that we will get the actual overheads figure, so that the management accounts would be correct and accurate, because we have adjusted the absorbed overhead to be equal to the actual overhead, so that at the end of the year, the management account is actually correct, and we just need to put it in a format that is required acceptable by the government, and then we submit for income tax. Okay, so you should watch the next video, because I will show you some past year exam questions, on this, and then you will have a much clearer picture on this. Okay, thanks.